What's up YouTube? It's me Gio from Robinhood Investing with Gio. Welcome back. In today's video, I thought I'd explain what it means to buy put options on Robinhood. 2021 is here and there's going to be a whole lot of new investors in the market, and some of them might even be considering trading options. In this video, I'm going to explain what buying puts means and what it means for you as an investor. Alright everyone, stay tuned.
What's up YouTube family? Just a quick FYI, if you're not subscribed, consider subscribing. On this channel we like to talk about stocks, options, and I like to give tips for beginners. If that sounds like something that interests you, consider subscribing. Alright guys, let's get into this. Alright guys, so how to buy puts on Robinhood. To get started, you first have to go to the stock, ETF, or bond that you want to buy, and you go over to the bottom tab that says trade options. In this case, we're going to do a buy put example with Nikola. Alright, once you're here, you should see a screen with a lot of numbers, percentages, and also dollar amounts. If you guys checked out my previous video, you'll recall that I did a call video that when you buy a call, that means that you think the price is going to go up. Now, in this example, we're going to buy a put. So when we buy a put, that means we think that the price is going to go down. The first thing we do is we look at the share price, much like when we were buying the call options. This time around, we're buying a put option. Previously, when we bought the call, we were looking at the price, the strike prices that were going up. Since we're buying a put, we're now looking at all the share prices that are going down. In this example, we see that the share price is $15.04, and the closest price that will be lower than $15.04 would be $15. From here, we have decided that we want to use this contract, which is again 100 shares of a stock that gives you the right but not the obligation to buy it. And we want to buy this put for this contract. In order to buy this contract, we have to pay a premium of 68 cents per 100 shares. So by purchasing 68 cents per 100 shares, and one contract is worth 100 shares, that means we would have to pay a total of $68 to buy this contract. So now that we bought our contract, it's important to understand that we have a set amount of time before this contract expires. You can think of it as a basketball player or any type of sports athlete. They all have contracts and all their contracts expire. Our contract, unfortunately, expires in just 1 week. So we have a 1 week time frame to get the share price of Nikola to fall below $14.32. And you might be asking yourself, why does it have to go below $14.32? The reason for that is, once again, we recall we bought a contract. We bought a put that we believe the price is going to go below $15. However, what we have to understand is that we initially paid 68 cents for that contract. So, in order for us to just break even, we have to deduct our upfront down payment that we paid for this contract, which would be $14.32. So when you deduct $15 from the 68 cents, you get a total of $14.32. Now, let's say we don't feel comfortable with this time frame. Let's say we don't like our contract and we want to extend it. What we could do is we could extend our contract by as much as 2 weeks, a month, or even years ahead. However, the longer you extend a contract, the more you'll have to pay in premiums. If you extend it for 2 weeks, the same contract that you purchased previously now goes up to $1.15 along with the share price to break even. If you go even farther along, you see that the price continues to rise. This contract expires in over 2 years, and in order for you to get the same strike price, now it shows $15 strike price, but this time around, to break even, you have to go a whopping negative 62.43%. The reason for this is because the person that's selling you this contract is putting a lot more risk on the table by extending his or her time frame by over 2 years. Therefore, you have to pay a lofty premium if you do want to purchase this contract in particular. So you might be asking yourself, how do you make money when you buy a put? What's the deal? What's the catch? So, as I mentioned before, the current share price is at $15.04. and we chose a $15 strike price. In order for us to make money, we have to make sure that this share price goes below $14.32. For example, let's say on the expiration date of January 8th, 2021, the share price of Nikola drops down to a total of $14. Because our break even was $14.32, any penny it goes below that equals profit. And another thing to remember is that every contract we have is 100 shares. So 1 cent equates to one total dollar. So every time it goes down 1 cent, you get $1. If it goes down 2 cents, you get $2. In this particular case, it went down a total of 32 cents to a total of $14. So 32 cents times 100 would equate to a grand total of $32. And just to hammer the point home, let's say our price of $15.04 on the expiration date of January 8th goes down to a total of $10. What that would mean is that if our break even was $14.32 and now it's at $10, we would get a total of $432. One thing you might be wondering is why you have to pay such a high premium for a company such as Nikola. If you just look at the charts, the bi-weekly charts at $115, or even the monthly chart, which charges you a whopping $183. And there's a good reason for that. There's a couple of reasons for the prices to have such high premiums. One of the main reasons is time value, but another important thing to focus on when you're buying puts or buying calls is focusing on the implied volatility. The higher the implied volatility is, usually the higher the premiums you'll have to pay. We could take a quick glance at a company such as Ford Motors. We could see their implied volatility is a measly 32%, meaning this company isn't very volatile, doesn't move up a lot, and it doesn't go down a lot, while a company such as Nikola moves up and down all around all the time. Important thing to understand when you buy a put, it means that you are feeling bearish in the company. When you feel bearish, that means you think the company's share price is going to go down in the short or in the long term. So it's very important for you to understand this before you do any kind of buying of puts in the stock market. But yeah, guys, that'll do it for me for today. If you would do me a great favor, and if you enjoyed this video or learned anything, consider subscribing. My name is Gio, and I do videos like this all the time. Alright everyone, I'll see you guys next time. Take care everyone. See ya.